All right, welcome back. The Moody's headline was really nothing but another buying opportunity. That's the point of view of my next guest. And if it matters, it's also my point of view as well. He goes on to say that the timing of the Moody's downgrade is very strange. They watched our deficit explode to $37 trillion, and now they decide to downgrade the U.S.? They have really no credibility, and the market proved that yesterday. It shook off the Moody's news, and by noon, finished higher on the day. So many have missed this rally that our next guest thinks that they're going to be forced to buy these dips, and this puts a floor on any really big near-term drops. He thinks these drops are going to be controlled and not real steep. He also expects to hit new highs in this market this summer before we have anything to really worry about, maybe some possible headwinds towards the end of the year. So for now, folks, we need to recognize this is a risk-on market, he says, and stop fighting that tape. And if you were wrong, just pivot, close your eyes and start buying, and then you can salvage the year. So without giving away any more of his secrets, let's bring him on and see what he's got to say about it all. Mr. Eddie Ghabour, thanks for coming on from Key Advisors Wealth Management. I don't doubt you, and we were just off air talking, and I'll tell everybody else what we were talking about, but I just felt as though a lot of the bad news is in the market. A lot of times we say the good news is in the market, right? But I think a lot of the bad news is in the market. I don't know if the administration is giving us the correct number, but it seems as though there's a lot of countries out there signing up. They want to sign up to a trade deal, right? It seems as though we'll probably get this big, beautiful bill passed. It seems as though we're going to get a rate cut or two, whether I think we should or not. Eddie, those types of things out there make me not want to be underinvested.
Yeah, that's exactly right. And here's the thing. This has been one of the most hated rallies that I've seen in my career. And a lot of people have been caught off sides with this rally. They're still sitting on a lot of cash. So I think the probability of the headlines coming out in the next 40 days is going to be positive news, because we're going to get India. We're going to get all these other countries to start signing trade deals. And to your point, if we get tax cuts, deregulation, these dips, these folks are going to be forced to buy because they're so underinvested. And so we took yesterday's open and we took advantage of it and bought more. And we're pretty much fully invested, thank goodness, because we've been dollar cost averaging since April. And now I think it is a bull market. It's a risk on environment. And as you said earlier, we've learned that if you're wrong, have the humility to pivot and don't fight the tape. But unfortunately, I think I'm still seeing a lot of people continue to beat the drum of a recession. And I don't see where they're coming up with this. Respectfully, I don't see any reason to be concerned with a recession here in the coming months, and stop worrying about what might happen and be in the moment and play this bull market, because you're going to miss the big part of the move if you're not in this summer.
So, having been in your spot before, I always worry about what might, happen to my customers, right? I try to look for some negative news and make sure that we've got it all covered, like a good risk manager should. But, what should I worry about as far as, maybe rolling over this debt from? I think that we're borrowing a 1.5 or something right now, and we're going to have to roll it over at over 4%, right? That has a chance of blowing out that 10-year yield to maybe 5% or even over 5%. What happens if we start to see this 10-year yield or some of our treasuries make these moves higher as far as interest rates go? Is that going to dampen any of these moves?
It will. And look, you're 100% correct. As bullish as we are always looking at risk factors that could cause things to go in the opposite direction. And two biggest risks that we have, we've shared with clients, is number one is the bond market. If the bond market gets too hot too soon, you'll start to see stocks make lower lows and lower highs. You'll get signals. The markets are smart. The markets will give you some signals that there's warnings and things to be worried about. And that's when you have to sometimes start de-risking. So bond market, number one. You also have to worry about Japan in regards to their yields. We're looking at that as well, too, watching that closely. And then lastly, I think the most obvious is if there is a hiccup with the U.S. and China on a trade deal, and we go back to where we were in March, that's going to be a problem. So there's definitely risks out there. But the markets, again, I think will give you signals if your process is right in regards to when to start worrying about them and starting to de-risk. But right now, all the signals look to a Goldilocks market here of the next 30 to 45 days.
And to your point of these bonds, and I got about 60, 120 seconds here. I just want the viewers to understand, and we're going to talk about it we're actually going to talk about the Bank of Japan and JGBs in the next segment, believe it or not. I'm going to try to do that. But it can sometimes be a topic where the red mist comes down and people don't get it. But at the end of the day, when we need to borrow money, and we need to borrow money, we sell bonds, right? So we take into cash, we give somebody something that we're going to pay the bonds back, or we're going to pay the money back that we borrowed from them. And so when we have to sell bonds, a lot of times we have to sell a lot because we need to borrow a lot. That drives the price of bonds down, which drives the yield on those bonds higher. That's what we're talking about here in the States. That's what we're talking about what's going on in Japan, too. You see these yields spike because these governments, these big Western governments, they're Western-ish, I would say, in Japan, are having to borrow a lot of money, and they're selling a lot of bonds into the market. And what they call these bond vigilantes, they put their hands in their pockets, and they don't bid for the bonds until they get to really cheap prices, and those prices equate to a lot higher yields, correct?
That's exactly right. When you look at the capital markets, the biggest bear market out there have been government bonds. You know, we haven't owned government bond ETFs in a while because it's just not been a place to put capital. And I think the trend over the next few years is going to be rates are higher because structurally inflation is going to stay elevated. And if we get accelerated growth on the economy, which I think we will get, that will also drive rates up. So if rates are going up because growth is accelerating, that's not a bad scenario. But if you're getting rates going up because you're in a stagflationary environment, that's a much different story.
And I think we'll get the growth. I agree with you. And I think that rates are going to be higher. I totally agree with you there as well. And, you know, to this problem that we talk about all the time, you know, a 5% 10-year seems expensive to a lot of people out there, but I've been around a long time. It's a 30 or 40-year average. I mean, it's not crazy yet, right? Number one. And we're going to have a generation of people go through that slowly but surely accept the fact that mortgage rates are going to be between 6 and 7 or just over 7. And I don't know how old you are, but 7.5 or 7 3/4 was a great rate for me on the second place I bought. I remember skipping home because it was a 30-year low at the time. So we're going to have to get people used to those higher rates. And if we do have the growth, that'll be okay, correct?
Agreed. I think and I think it's healthy, right? When you have yields too low, that's what got us in this problem now.
100% correct.
We need to adjust that this is actually a normal environment. Rates actually aren't high.
Right.
This is where they should be.
Right.
We've just been spoiled with zero interest rate policy, and that's been the wrong policy to have. So if we get a little bit of pain because rates are higher, the economy, the markets, and the consumer will adjust to it. You'll have less speculation, and you'll have more normalized growth in real estate and the capital markets, in my opinion. So I hope rates stay right where they are.
And, you know, real quick before we go, 10 seconds. Remember about 20 years ago, we talked about normalization all the time, getting the Fed out of our back pocket. It's now finally starting to happen, but nobody's using the word until you just did right then. Thank you very much for coming on, Eddie. You're awesome. Great to have you on. See you again next week. Eddie Ghabour.